Hi, my name is Pat Greenhouse and I'm a CPA at Dermody Burke & Brown, and I'll be discussing things to consider when filing your 2018 New York State taxes. New York State has decoupled from many of the individual tax provisions of the Tax Cuts and Jobs Act. For instance, they are saying not so fast and stepping back in time to the old law before the Tax Cuts and Jobs Act was enacted. What does this mean? Let's consider the above-the-line deductions for moving expenses and alimony. The 2018 Empire State Child Tax Credits are now going to be also based on the old 2017 laws for the credit amounts and the income thresholds. Standard deductions is another area where there are a lot of differences. In the past, if you took the federal standard deduction, you were also required to take the New York State standard deduction. This is no longer the case. You can take the larger federal standard deductions, but still itemized in New York State. However, beware, because the amounts that you can take as New York State itemized deductions are based on the old tax law. While these are no longer allowed for federal purposes in most instances, New York State is allowing the deductions for the qualified job-related moving expenses and are looking at the old rules for the alimony payments and income. Finally, if you have a qualified distribution from a 529 plan for federal purposes for tuition paid for K through 12, this is disqualified in New York State. The New York State tax rates range from 4 to 8.2%. So knowing these decoupling provisions can certainly help you save on your New York State taxes. Please contact your tax advisors at Dermody Burke & Brown for further assistance.